Famous lesson about a margin of safety, that you don't drive a truck that weighs 9,900 pounds across a bridge that says limit 10,000 pounds, because you can't be that sure about it. If you see something like that, you go down a little further down the road and you find one that says limit 20,000 pounds, and that's the one you drive across.
What is a margin of safety? A margin of safety is the discount to the intrinsic value of a company you buy. You can think of it as your cushion for potential mistakes in your evaluation. If PayPal's intrinsic value is $200 and it drops to $100, my margin of safety is 50%. I have a 50% cushion for potential mistakes that I made in my evaluation. The reason that's so important is because we're all human. We all make mistakes. If I made a mistake in my evaluation, I have such a large cushion that chances are I'm still gonna make money.
Warren Buffett made a ton of money following this one principle: buying a company that's worth $1, but only paying 50 cents. This concept is known as margin of safety. Well, if it was that easy to value companies, everyone would be doing this, right? And that's the point of this principle. It's pretty hard to value a company. Well, it's easy, but the million-dollar question is that valuation correct? Because the valuation of a company using something like a discounted cash flow model, you may come up with a value of $20 billion for a company. But there is a ton of assumptions that go into that valuation. But if the current value of that company is $10 billion, well, now even if your assumptions are slightly wrong for the $20 billion valuation and it's actually $17 billion, hey, you're still getting a great deal. So in this situation, it would be a buy. Well, let's say the valuation was $20 billion. You thought the fair value of the business was $20 billion. Well, now there's not as much upside, so it makes less sense to put a ton of money into this investment. And if your assumptions are wrong now and it's worth $17 billion, well, there's more downside than in the previous situation. So with this setup, you would do nothing. The whole point of margin of safety is be patient and wait to buy at a good price, giving yourself a buffer.
Okay guys, in this video I'm going to talk about margin of safety. This is a very, very important concept to learn. I learned it from reading the book The Intelligent Investor from Ben Graham. And Ben Graham wrote a book, it's chapter 20 in his book. And he wrote this book to teach investors how to invest. And Ben Graham is the actual teacher of Warren Buffett. So, you know, it's like learning from, you know, it's like Michael Jordan learning from Phil Jackson, or, you know, Wayne Gretzky learning how to play hockey from his father, Walter, right? So it's learning from the best of the best here. So what Ben talks about margin of safety, he's talking about a very simple concept, right? He's talking about buying things for just less than their worth. Now, it seems very simple and common sense, but a lot of people don't do this in the stock market. A lot of people overpay for stocks, or they overpay for real estate. So, for example, let's say you do a fundamental analysis of the company Apple, right? You determine that it's worth $2 trillion. Okay, fair enough. Now, the whole idea with margin of safety is you just want to make sure you buy it under 2 trillion. So let's say the market crashed a little bit and it went down to, say, $1.5 trillion, and you still think it's worth 2 trillion, then you can buy it, and that gives you, you know, about a 25% margin of safety. Or using real estate, let's say you're looking at an apartment building and it's worth, say the current value is $1 million and it's generating $100,000 net cash flow per year, so it's a 10 cap. So you might say, okay, that's fair value. And then say something happens, the person goes through a divorce or they have a bankruptcy, and you're able to pick it up for, you know, $700,000. So now you have a margin of safety when you purchase that. It's better to purchase that instead of to pay, you know, 1.2 million or 1.5 million, right? It's very obvious. It's pretty common sense in my opinion, but a lot of people forget this when they're investing, right? They just get excited, they see the stock rising or they see the real estate rising so high that they just forget about margin of safety. So in order to make the most amount of money, you want to always buy with a margin of safety. Okay guys, so that's it for this one, and we'll see you on the next video.
You just have to be patient and disciplined. But what I really think is, you need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow up is because of leverage. And then you need to balance arrogance and humility. And I'll explain what I mean. When you buy anything, it's an arrogant act. You're saying the markets are gyrating and somebody wants to sell this to me and I know more than everybody else, so I'm going to stand here and buy it. I'm going to pay 1/8 more than the next guy wants to pay and buy it. That's arrogant. And you need the humility to say, but I might be wrong. And you have to do that on everything.